Breaking news, we have seen a beat on expectations, a bigger build, Bridie, for the month of January, and that unemployment rate stays right where it's at 5.4%. Let's get a dollar reaction straight off on this one. Build of 10,400, market said 5,000, so roughly double the projected call. That's enough to keep the unemployment rate steady at 5.4.
And that participation rate actually falling 65%, and full-time employment also again disappointing, down nearly 10,000. So when you break down the numbers, full-time employment, a loss there of 9,800 full-time jobs, yet unemployment rate stays at 5.4% because overall total employment in January 10,400. So I guess what more part-time there, obviously helping to keep that unemployment rate around that 5.4%.
Dollar pops, as you might expect. Simon Boulton is from Aequalis. He's with us in studio. Simon, welcome back. Interestingly, the participation rate did not meet expectations, coming in at the 65 level, bang on. The call was for 65.1. What does that do more broadly to numbers as they drop?
I think it's a reflection of the job-seeking market as well as the hiring market. So there's a bit of softness in that we probably have seen reflected in that fall in the participation rate. So a few unexpected turns there. I mean, it was expected to go up today to 5.5. We've held at 5.4. So again, it seems to be the job numbers continue to be fairly solid.
How does this match with, I mean, what you're seeing, you know, at the ground, at the coalface, as you like?
Look, I think that the steady as she goes is probably the attitude at the moment. I think time of year, people are just getting back in and looking at their plans. I would say there's probably a little bit more, not necessarily positivity, but I think people are now feeling that it is time for action. I think people have sat on their hands. I think corporates are now thinking, well, we can't keep sitting on our hands. We can't keep just watching and waiting. So I think there is some probably more positivity in the hiring behaviours out there at the moment, certainly with our clients.
The part-time build, which did, as you mentioned, Bridie, shoot the lights out with 20,200 versus that full-time component where we've shed almost 10,000 roles. Is that actually to be welcomed, given that push on productivity? A lot of talk has been out there in the market, but not much action. I know Chartered McLeod's survey showing that dislocate. Do you find encouragement that part-time at least looks to be fairly solid?
Yeah, and I think it reflects as well, Carson, the the use of temps and contract workers is certainly something we're still seeing very strong. Organisations are sort of hedging their bets, not willing to go for the full permanent sort of commitment.
In any particular sectors where that really shows through in your space?
Look, I think that the service industries, the business services, professional services firms, legal firms, accounting firms, we're certainly seeing things there looking a little bit fuller. But I think the underlying message here is the employment rate's steady. We're still creating enough jobs to keep it steady. So, yeah, again...
Just though, right? Because the 15,000 is almost that line in the sand, isn't it, per month? Yeah. Just to keep things where they are, given that natural attrition, given the retirement and all the rest of it that comes with this economy.
I agree. But
which we're barely doing on 10,000 today.
Well, I think a holding pattern is a good result. I think that general commentary is that the figures are going to increase through the year. I think that's probably right. We're going to have a creep on the employment numbers. Whether or not we get to that 6% that some people are suggesting, I'm not certain. But there is going to be, I think, a general creep of that employment number up, and that wouldn't be a surprise to anyone.
How much do you make, though, of the fact that, the part-time employment, you only have to work, an hour to be counted as a part-time employee? I mean, that's not really... a full contribution in the workforce, is it? I mean, that's a sign that, there's companies there that aren't really hiring truly.
Sure. I think January as well, there's still some work that comes out of that is part-time, as the leftover in the retail sector. With the events in Queensland, I think that will have another effect on the employment levels next month. And we saw that last time there were those natural disasters up there. So that peak in sort of that part-time work, I think, will increase as well.
So maybe March is when the dust settles, from what you just said there.
I think there is that sort of pause. People have just got back into the role. Board meetings are now just starting to happen. So we're going to see some more, I think, definitive answers as the year moves forward. So yeah, I think by March, Carson, I'd like to say.
You're sceptical on forward indicators, even like job ad series, which we've had again this week. On today's numbers, does that validate that ANZ series? Does it completely confine it to the dustbin?
I'm not sure, but the interesting thing this time is that SEEK actually released some numbers as well, saying that their job advertisements had increased. The ANZ numbers were saying that they'd significantly decreased. Their lead indicators, like you say, I think that there's some advertising behaviour that needs to be taken into account there as well. Not every job is advertised, as we always say, every month. So the ANZ numbers, Yeah, there's probably cause to be a little bit speculative about them. They do follow the job unemployment rate, and they've shown that. But I think the counting of numbers of adverts over the course of 4 weeks isn't necessarily a great indicator on what's happening in the broader picture.
What do you think then? I mean, does this lessen the chances of the RBA cutting again, or do you think that they should be cutting to try and get that hiring going?
It's a difficult question. I guess that as long as we get this steadiness in the unemployment numbers, I think that just causes the action to probably be hold. What we're not going to see in the employment is, I think, a big spike. We're never going to see it go from 5.4 to 5.7 or something like that. So it's still one of those sort of slowly evolving numbers that how the RBA determine it as an indicator, I'm not sure.
Simon, just a thought as well for prospective candidates in the market. What consistently do you hear from employers that they're not getting from applications, that they're wanting to see at this point in the cycle that smart employees could actually be serving up if they were a bit more strategic with their applications?
I think that's probably true. I think at the moment there's, what I would say is a drifting trust between employer and employee. I think we're seeing that again. We saw it in sort of 08, 09 when employees just weren't sure what was going to be happening. Employers weren't really communicating that very well. So that is leading to an increase in job seekers. From a hiring perspective, the candidate pool is still very tight. Specialist skills are in short supply, and that I think will continue as we see the pressure put on organisations to build those sort of specialist skills in the business.
We were talking to Clarius Group a little earlier in the week, and they'd just done some surveys, and they're predicting that there'll be high rates of churn come mid-year, that at the moment a lot of those great staff that the companies have retained, sure, the employers are in the box seat right now, but come mid-year, those employers, those specialised employees are going to get sick of the fact that they're having to multi-skill, that they're having to be a lot more productive for the same money, and that there will be rates of leaving, and it will turn, that the tables will turn.
Absolutely. I mean, job losses, the work still needs to be done. So people will start to be increasingly overworked, they'll start to be underpaid, and that's where that sort of discontent comes from in the workforce, I think. As employers are putting more for less, that's really what every employer wants, do more with less. And that does put a strain on your existing workforce. And as you say, that will start to, I think, take effect perhaps mid-year. It really depends on how we see the full unemployment numbers sort of track.
Well, Simon, we might just leave it all there, but it's always great to get your instant analysis.
Thank you, Carson.
Happy New Year. Welcome back into the series. We're late saying that because, of course, maybe
when you actually stop saying
we don't really count January, do we? There was so much noise and so much kind of...
Not at my place.
Okay. Gee up. We'll see you next month.
All right. Simon Boulton there from Aequalis. And of course, let's just bring you a reminder of those headline numbers. Unemployment rate staying at 5.4%. We saw overall a creation of just over 10,000 jobs. Full-time employment, though, a big fall. Part-time employment, a big rise. 20,000 part-time jobs created. Participation rate staying at 65%. Let's have a look there at News Corp. And, of course, coming back to the earnings season, pulling off a positive second quarter earnings result, but shares getting punished. That because of the outlook. Just looking at net income, that came in at just under $2.4 billion. Stripping out one-off items, earnings per share 44 US cents a share, 1 cent higher than analysts' forecast. Revenues also beating estimates, coming in at 9.4 billion US. Cable network programming revenues making up the biggest slice of the pie, that coming in at $2.6 billion. But publishing wasn't too far behind, total sales there of 2.2 billion. But the result seen as a bit of a disappointment, given that the company has, for the past few quarters, really blown away analysts' expectations.
When it comes to stocks, it doesn't matter if the company's growing profits by 20% or 50%. It's all about expectations. And News Corp, unfortunately, has come in below expectations. It, of course, is also listed in the US, and we did see a sell-off in the US market. So we are expecting to see the same on the Australian share market today. If we have a look at what's been a key driver of News Corp over the years, it has been the cable business, but it does look like costs now rising. So News Corporation expected to be one of the weak performers on the Aussie share market today. We've already got an indication of how it's going to trade through its US shares, and really just missing the market. They have had a strong profit result, but the market was just expecting more.
And News Corp shares now worst performing on the ASX 200, down 4.3%.
Well, this is an interesting story now because Australand, the property groups today come out with a healthy rise in profit. The full-year earnings just under the $180 million mark, which is a rise of almost 30% on year. The sales figure has been the black mark in these numbers, though. $919 million. That was certainly below the $1.1 billion that the market was calling for. The property company saying this is still a challenging market. As a result, the first half profit in 2013 will probably be below that of H1 2012. Earnings, though, should be heavily skewed towards the second half of the year. Let's see how that stock is faring. Not so well today. ALZ is off 2.6%.
Well, of course, Mirvac considering a merger proposal for Australand, and we've seen Mirvac take a reasonably sized provision, the $270 million write-down, a result of the company realigning future assumptions with current market conditions. The majority of the projects impacted are in Queensland. CEO Susan Lloyd-Hurwitz says that the news is disappointing and that specific markets have remained subdued and aren't expected to improve to the extent previously expected. The company is, however, sticking to previous 2013 earnings per share guidance of about 10.7 cents per share. But still, Mirvac shares there down on that news today. We're seeing Mirvac off about 4.2%, so second worst performer on the ASX 200 right now.
Well, the Reserve Bank widely of the belief that construction sector, the beleaguering construction sector, starts to get a boost as that full effect of its previous easing hits that non-mining part of the economy. The problem is today the numbers point to the very opposite. This is the AI Group PCI index, the Performance Construction Index. It's fallen another 2.5 points in January. That's now seeing it sit at 36.25. Anything below the 50 level means you're in contractionary territory. House building clocked in the weakest read. New orders, they fell for the 32nd consecutive month. Well, AI Group Director of Public Policy Peter Byrne saying that the impact of interest rate cuts between May and December last year still hasn't delivered a pickup in activity.
There's been a sharp drop in employment participation in New Zealand, and that is the reason why there was a surprise fall in the unemployment rate. The seasonally adjusted rate fell to 6.9% in the fourth quarter. Analysts were expecting a read of 7.1%. Employment also missed expectations, down 1.4% on year against expectations of a 0.3% rise.
Unemployment rate dropped is because there were far fewer people seeking work, and in actual fact employment fell by 1%, so that's actually quite a weak outcome. Now, that fall in employment was confined to part-time work, and it was perhaps a question mark whether it's just something odd about seasonal employment or whether we do actually have yet another quarter of quite genuine employment weakness.
It is the third quarter in a row that the participation rate has dropped, with participation now at 67.2%.
Whitehaven shares have been weaker all session, and just looking across now, nothing's really changed on that score. I can tell you one of the catalysts now, the delay by the federal government on deciding whether or not to grant final environmental approval on its Maules Creek project. Well, the company's come out with a statement to the exchange saying it's been told by the Environmental Minister, Tony Burke, and the Department of Sustainability that this decision has been pushed back now by 3 months. Final decision was due inside the next few days and now be released on April the 30th. Well, MD Tony Haggerty's saying the group was extremely disappointed in this delay. The approval process for Maules Creek started in August of 2010. So that gives you a feel for just, delay and delay compounded. Down 4% on the news, those shares.
Mozambique's mines minister says she's confident of reaching a deal with Rio Tinto to solve the miners' infrastructure issues. Speaking on the sidelines of a conference in Cape Town, the minister said that Rio was open to continue working with the government, dismissing speculation that it could pull the plug. Rio recently took a $3 billion hit to its balance sheet, largely due to problems transporting coal to ports. The minister says that Mozambique is only part of the problem and is confident of a solution. Last month, Rio sacked its chief executive and took a $14 billion write-down, including the $3 billion related to those coal assets in Mozambique. And just looking at Rio's share price, it's trading higher today, up 0.8%, $68.65.
Well, it's not the kind of news you want to be lumbered with. High operating costs and falling commodity prices. They could claim another victim. Seems BHP is looking to sell its Gregory Craner mine. The mining giant's also looking at how it can keep the coking coal operation running while extending its mine life. BHP actually shut the Gregory open pit last year. It kept the Crinium underground mine open. The company saying any decision to divest or otherwise will take anywhere between 6 and 9 months. Well supported, notwithstanding BHP. Those shares are adding just on 0.2%. Not bad, given the broader market weakness.
Yeah, of course, we've also seen out alongside, of course, the jobs data at around 15 minutes ago. We've seen the NAB quarterly business survey for the December quarter out. A very weak read there, and we're going to be taking a look at that latest pulse on business conditions and that number, and of course retail sales yesterday too, coming up.
Stay with us. Alan Oster's next.